Hi, I'm Jim Griffin, Investment Content Manager here at Columbia Threadneedle Investments. Joining me on this edition of Eye of the Needle is my co-host Corinne Walker, Senior UK Wholesale Marketing Manager. Nice to see you, Corinne.
Hello, Jim. Looking forward to today's episode.
Indeed, and joining us today, we have two guests from our UK Equities desk. Richard Colwell, Head of UK Equities, and Jeremy Smith, Portfolio Manager and Head of UK Research. We're going to be talking to them about the much-maligned UK market, the themes, opportunities and challenges playing out there, and why I suspect they both think it's actually unfairly maligned and is in fact poised for something better. Welcome both.
Hi there, Jim.
Hi there.
Great. Now, before we get right into today's topic, can you maybe give us a bit of an overview of your background and what it is you do here at Columbia Threadneedle? Richard, do you want to start us off?
Yeah, I'll kick off. I'm head of the UK equity team and responsible in particular for some of the income funds. My background is a bit monoline. I've always been involved in UK equities, so for over 30 years, investing through many a cycle, and been at Columbia Threadneedle for 12 years.
Great. And Jeremy?
Yes, of course. So after initially qualifying as an accountant, I actually trained with Richard as an analyst and worked with Richard for 8 years in the UK market before moving on to a number of other roles. So in total, I've got over 30 years experience of investing in UK stocks across a range of small and large cap portfolios. I joined Columbia Threadneedle 6 years ago now, and I'm one of the senior portfolio managers and also head of research for UK stocks.
So you're thoroughly both versed in the UK then. Good stuff. Now, Richard, it's been a lively start to the year with markets all over the world struggling. We've got the S&P 500 down, the Nasdaq down, with tech in particular taking a pummeling, and in the UK, the FTSE 100 down. So if we can put you on the spot straight away, one of your main convictions, and it's one you've held for a long time, is that the UK is a fantastic opportunity, but it's had and is having a tough time. So why so positive?
Well, I think, we all know that investment phases go on for longer than you think, but I think it is worth stepping back and reflecting that we've lived in a very, very unusual situation going all the way back to the financial crisis of 2008 and the authorities' response to that in such huge monetary policy stimulus. And that was amplified still further in the COVID crisis. So that has caused quite a lot of distortions. And the UK equity market, particularly over the last 5 years, has been the whipping boy, really. It's been on the other side of the ledger to a lot of capital that has been chasing returns, perhaps without regards to what risks may be involved, which tends to have been in tech, in the US in particular. And so, I would argue that there was always going to be an after effect of the flash crash of 20. That couldn't have been just it. There has to be consequences, and the stock market and risk assets generally have had a good time. So we were well overdue a bit of turbulence. That's healthy. This fixation with keeping the plates spinning and, don't worry, the Fed will come in and save the day. Well, it's a good reminder that you can't have interest rates at zero forever. And the turbulence you've alluded to is just with the signaling by the US Fed that you never know, they might raise interest rates in total by a mighty total of 100 basis points over the next year or so. And it's just so far it's just caused a bit of fast money to reflect and take some off the table. Now, whether that feeds on itself, don't know. So although the UK is also having a tough time in aggregate, relative, it's doing better. So I'd say it's all to play for. We're in a very rotational market, and you could easily get whiplashed. So, it's as active investors who are stock pickers rather than fixated on thematic macro positioning. We've got to step away and not get caught out. We had similar sorts of vibes at the start of last year. I think this year will be different from last year, but it's a reminder that there's a long year ahead, and that the plate tectonics are starting to shift, I think, and the UK will be a beneficiary of that.
Great. Now, Jeremy, as a team, we've spoken about the UK being nuanced and not all about simple commodities and banks, please, but they're the ones that have been going up so far this year. What sort of companies are you looking at, if not those, and why?
The market's sort of, we live in a world now, I suppose, of one decision investing where, it's inflation or deflation, it's growth or value, it's kind of boom or bust. And, the way that the investment banks package up kind of how to sell those products inevitably focuses on the big parts of the market where they can make the most money. So, we have an anti-momentum screening process to look for where, the crowded trades aren't. Where if you've got a burning building and everyone's running out, we're the ones probably one of the few people running in to have a look and see how big the fire is. So, some of the sectors that are outperforming so far this year, banks and energy, yes, but also tobacco, also defence, also telecoms. Those sectors are outperforming in the S&P. They're also outperforming in Europe, but they're bigger parts of our index. And so for once, our market becomes more relevant potentially to the marginal investor. The last 4 or 5 years have really been about super tech and growth, and technology's only been 1% of our index, whereas it's been 28% of the S&P. But the sectors I've just talked about are more representative of our index than they are potentially of other indices. So if you're looking for a potential investment in the current environment, the UK does screen, and that's for the first time really in a few of those, in 3 or 4 years. So, earnings momentum is turning positive in those sectors.
So, Richard, something else that's hugely topical at the moment is ESG investing. That is environmental, social, and governance. And it's becoming increasingly important for clients that their investments have positive outcomes as well as delivering financial returns. As active managers, as you mentioned before, you've long had an input into how companies are run. Can you tell us a bit more about this process and what additional value it can bring?
Yeah, I mean, we think it's common sense investing, but I think it is differentiated in the sense that with the growth of passive investing and quant, it's really important for active investors such as ourselves to have a say and use our voice, that we are owners of businesses, not renters, and that we want to embrace the K report, and therefore we want to engage with companies to affect change for the positive. We're not talking about backseat driving. We're just we're trying to ensure good behaviours. The S and the G should always have been there and really important, and therefore some of our best investments over the last decade have started with the kind of engagement that's perhaps required management change or a realignment of strategy, to really focus a business. And so, that's really important, and that's something we're really proud of at Columbia Threadneedle on the UK equity desk in particular. That we think we've got a good track record in that respect. Now, obviously, the E, environmental, is really important for all of us now, and it's been incumbent on us as a business to ensure that we really have the resource to engage effectively in these issues, as well as you say, to affect positive outcomes. And it's to engage to improve is our mantra, rather than defaults to hard exclusions. Now, if customers require that, we can accommodate that. But our default is we want to roll up our sleeves and engage for improvement.
And Jeremy, that's actually a bit of a differentiator, isn't it? The idea of being active managers, having a say in companies and how they're run, because the market is increasingly dominated by passive investors and ETFs and the like. Tell us a bit about that and why the UK market is good for ESG investors.
Yeah, I mean, on a daily basis, we think that active investors, sort of people we are, is about 10 to 12% of the daily flow of stocks. So quant investing, passive investing, hedge funds dominate the daily flows, but they are renters of shares. They're not owners of businesses. So they're not interested in environmental sustainability or governance factors. We because we're conviction investors, we tend to have large positions in businesses. We invest on a 3 to 5 year view, sometimes in many cases longer. So it's not unusual for us to end up with large stakes in businesses, and that position gives us a fiduciary duty to act responsibly as a proper stakeholder in that business. And so we have proper engagement at all levels in the business. We use our very well-resourced ESG function to engage at different angles, not just on the financials, which we tend to focus on in the UK team. So together you end up with a more holistic view of the sustainability of that investment. And in many cases, we're able to take best practice in some companies and present that as an option for others to act on. And then from a director's point of view, Richard and I, we've, as we talked about at the very beginning, we've been investing in UK market for 30 years. The average tenure of a CEO is probably 5 to 7 years. So, particularly with the latest round of fundraising during the COVID crisis, a lot of CEOs and FDs were raising money for the first time in their careers, whereas we've been through several cycles. So we've been acting responsibly in that situation, advising the companies whether it's a good thing, a bad thing. And in some cases, we were able to actually halt the process for companies that wanted to raise money at the wrong price. And I give them some breathing time to structure a deal that was much better outcome for all investors.
That's interesting. I like the idea of owners, not renters. That's a nice phrase. Richard, now in your outlook viewpoint for 2022, you spoke about the notion of a bezel. That is an as on yet revealed inventory of nasty shocks that build up in the good times, and they only reveal themselves when tougher times arrive. You named Bitcoin in that, and that's certainly had a painful 22 so far. Can you tell us a bit more about this bezel idea? And given the start of the year for equity markets, is it the case that the tough times are already here?
Yeah, well, I'm unapologetic about borrowing other people's ideas. So bezel is from the great Galbraith. So who am I to say? But it was a good phrase, I thought, especially in the lead up to Christmas, etc. So if you keep saying it often enough, eventually you might get lucky on the timing. So it does look quite fortuitous that, as you say, there's been a bit of a reality check on some of the areas of the markets that have exhibited bezel characteristics. So way too early to declare I told you so or anything like that, because nothing goes up or down in a straight line, and we could have a violent recovery quite easily in some of those areas that have had a tough start to this calendar year. But it is about it's about animal spirits, really, and going back to those previous cycles that myself and Jeremy remember very well. What was known as the TMT bubble, that was technology, media, and telecoms at that time, in the late 90s, and then that cracked for initially in March of 2000, post-millennial. But that was not because of an interest rate move by the Fed. That was actually that was just to say a collective sobering up of the market, if you like. And I think that's an element of what's gone on at the start of this year, that although the narrative is it's all about the 10-year yield and paint by numbers investing tells you sell long duration tech and you rush to the other side of the ship and you buy oil and banks, etc. And that's why we think it is more nuanced than that. But I do think it was well overdue a reality check that when you've got, within NASDAQ now, I think getting on for half of the constituents, more than 50% below their peak, that is quite interesting. But if you've got a price to sales of over 20, there's not a lot of margin for error. You could still be an interesting potential disruptor, but who knows what the right valuation of that. And I think it's right that some of the pandemic winners, such as good old Peloton, have had a bit of a reality check. Now, the big issue for markets is, what about the big dogs, the huge mega cap tech companies? And the likes of Amazon, have been phenomenal for compounders for global investors. But could they have a period where it's a more subdued share price? It's already fallen a reasonable amount, but it's sort of a bit King Canute to say get in the way of that investment. But there are periods that we can go back to in previous cycles, even before me and Jeremy in the 70s, and the demise of what was then known as the Nifty 50 quality growth names of its day. And it's the derating. These big companies could still be very attractive investments, but they could derate, even if profits make progress. So I think that's important to remember, and it's this lack of moral hazard ever since the financial crisis that the Fed's got your back. If things get too tough, they'll come to the rescue. That there needs to be a check on that, and I think it's we don't need zero interest rates. It's not a good thing. See Europe for details, and it's right that we're having a bit of a price for money coming into the equation.
So Jeremy, do you agree with Richard? Is this a big sell-off, and does it make the UK more attractive? As a fund manager, how do you position yourself in this kind of environment?
Yeah, the UK market's really been the carry trade for buying US tech for 4 or 5 years now. Brexit, COVID, not very much technology in the UK market. They've all been fantastic reasons to have no exposure to the UK market. And we've been derated over that time. Since mid-2016, the UK market has derated by 23%, whilst the S&P is re-rated by 28%. So in this sell-off now, as rates start to go up, the extended rally that we've seen in US tech, it's right that that's selling down and the ratings are starting to come down. In an inflationary environment, risk assets do sell off. And so the UK market as an entity is not immune. But outside of the noise of the big sectors, there's been a lot of progress in a lot of companies over the last 5 years to position themselves to get through Brexit. A lot of companies have come out of COVID stronger than when they went in. Businesses have got the ability now to take much greater market share. It's been an unusual phase for companies because incumbents with access to capital markets have been able to restore their balance sheets quicker than small companies, and they're able to move out of this COVID phase quicker than small companies because of their stronger balance sheets and their market positioning. So turning the sort of the previous 5 years theme on its head, away from disruptors and back towards incumbents, there's plenty of companies on the UK stock market that are good at what they do. They're one of 2 or 3 global players. They just haven't been in the spotlight of the sectors that have been in the crosshairs of investor fascination for the last 3 or 4 years. And we're well represented in that. So is the UK market immune from a global sell-off in equities? No, it's not. But from a relative perspective, we're coming from a much lower base than everyone else, particularly the US. And so from a relative perspective, the UK market, we're not surprised that, year to date is outperforming the S&P by 10%.
But as you say, it's not immune. And if we could stay with you, Jeremy, and talk about potential headwinds that the UK market faces, we've got a government kind of mired in controversy and cake. Inflation is at a 30-year high. There are supply chain issues. COVID, of course. I mean, we have recently opened up as a country, but it's not gone away. And I guess there's continuing needle with Europe as well. So does this kind of noise influence you at all, or are you able to see through it?
I mean, we're obviously read a lot about the macro environment and the global economy. We're cognizant of the trends, we're cognizant of the issues, but we focus all of our research effort on individual companies. So we're screening for businesses that have got a good 10-year track record of returns, but if something has gone wrong for those individual companies, either in a division or the wrong management or at the wrong stage of the cycle. And so we're patient investors, we're valuation sensitive, we take our time, we build our positions, and we have a long duration in terms of our investment horizon. So yes, there's a lot of noise in the short term, but a lot of these businesses, and it's a key characteristic actually of the UK market, there's a lot of businesses that have a lot of ability to control their own destiny, particularly if you're coming from a low base in recovering the business franchise. You've got a lot of self-help in there. So whilst the external environment can be challenging, and there's no doubt in what you've said, there's a lot of headwinds there for the global economy and for the UK market, a lot of the businesses that we're invested in have got that ability, a greater ability to influence their revenues and particularly their profitability coming from a low base.
I would add, actually, Jim, just thinking about it, is sort of what we've tried to articulate to clients is that, we invest in UK listed companies. Yeah. We don't invest in UK politics or even the UK economy. So although, as Jeremy says, we're not immune to those external factors, and they are of some relevance, it's not a kind of popularity voting mechanism. I think again, referencing previous economic cycles, that there are these risks. But it is interesting to go back to the start of the century, and not just the drawdown in markets that precipitated the crack of the tech bubble in 2000s, but the subsequent recovery in the stock market, so that the UK did much better than the US for a sustained period in the early 2000s all the way up to about 2006. So who knows where we are in this economic and stock market cycle, but that is a good reference point. I think that we could be an insulator but not immune if there is going to be more prolonged turbulence in global markets, like we were in the early 2000s. But like from 2002, it could be that if the market merely broadens out, that there is this reappraisal of UK equities, which have endured a kind of double discount over the last 5 years, when a lot of the progress made globally has been a re-rating rather than just an earnings growth. So I do think that things can change. And we could be entering a new phase in investment cycles.
Absolutely. So another feature of the UK market and active management is the amount of mergers and acquisitions. There have been countless examples of this over the past few years, Agreco, RSA and Morrisons. Do you expect this to continue? And given what we've discussed about the UK being unloved, who or what is driving it all?
Yeah, I think it's a really interesting feature that normally the level of M&A starts to peak quite late cycle. And again, reference that's the early 2000s, that there's elements that remind us of 2005-6, where we also saw a lot of incoming bids for UK listed stocks. So that's why it's unusual that we've only just come out, or just coming out of the COVID era and the massive dislocation economically that's caused, and yet we're already seeing elevated levels of M&A, and the UK is a real recipient of that. And I think it goes back to the earlier question. It's who are these buyers? Overseas corporates, private equity, and there's also activists who are agitating for change. Now, do these participants have a view on our politicians or where sterling's going to be? Do they have a benchmark? No, they don't. They're looking for absolute risk-adjusted returns, and they're finding in their screening and due diligence that the UK is an interesting hunting ground. So every time an investor reduces their exposure to UK equities to go into more growth and vision overseas, you got to ask yourself, well, who's buying your stock when you're selling? And Morrison's and RSA, they kind of went sideways for 5 years before the bid, and then it's only after the event everybody wraps themselves in the flag and says, gosh, it's gone out on the cheap. We're trying to look at stocks through a different lens. If the market's fixated just with earnings, we are looking at the cash flows or the asset value. And as a patient investor, we're going to try and work hard to realise those gains. But we're nervous because of this double discount the UK's on. It's not quite the same as '06, because in '06 at least we'd enjoyed a recovery in UK equities, both in earnings and rating, whereas this time the fear is that companies could go out below their intrinsic value. And that's why we're working closely with the boards of companies to think like you're an activist. How can you try and close that discount before you get activists on your share register, before there's incoming bid approaches?
Okay, a final question then. It seems a bit like we're entering the third phase of COVID. We had the flash crash in March 2020 when the virus first took hold. We've had the COVID bounce after vaccine announcements, and now we've got inflation, but we don't know if is it supply chain driven. Is stagflation has been mentioned, so high inflation, high unemployment, and stagnant demand, or I think a phrase you've used before, Richard, is it out of the bottle for good inflation? Are we heading back to the 80s and early 90s of consistently higher levels than now? I don't know which one of you wants to step in, but what happens next, do you think?
Well, I can say a little bit, and then Jeremy can step in as well. I mean, I suppose, we're in this situation where demand came flying out of hibernation, and the global supply was a bit sleepyhead and is catching up. So this supply chain disruption, which has amplified the inflation impulse, is something that we're going to be wrestling with this year. So it's, again, borrowing phraseology from somebody else. Last year was peak growth economically. This year, I think, is peak inflation, and maybe next year is peak interest rates. So, as you say, it could break either one of several ways. In terms of could there be policy errors? Could they tighten too much and reduce the central bank's balance sheets too quickly? Or could we have a Goldilocks scenario of, that this inflation impulse is now kind of at its peak and that will soon settle down, and that economic growth can remain above trend for a few more years? That would be all nice and rosy. Or, as you say, my gosh, could we have a reprieve of stagflation? So it's some big calls, and to be allocating and choosing your funds or for us to choose stocks and sectors based purely on that kind of top-down macro view, I think could be quite dangerous. I think it's about having balance and flexibility, and maybe there's been too much inflexibility from the authorities and some investors thinking anchoring to zero interest rates are here to stay because that's all we've ever known since '09. So, we want that flexibility, and we want companies that can prosper coming out of the COVID disruption and have come out of it stronger from that crisis. They've got pricing power because they've got value-added services and products, or they've got scope for productivity gains to offset some of those headwinds on cost. And I do think it's sort of, you looked after all your stakeholders, your employees, your suppliers through the first few phases of COVID, then it should set you up for whatever's the next phase of the COVID era, as we learn to live with it, and hopefully it morphs into a more new normal way of life. Jeremy, I don't know if you would add much.
Well, obviously we don't know. We have no crystal ball to give us the answer, but we're hopeful we're heading into a period of more kind of policy normalisation than we've been through, particularly over the last 2 years of excessive, loose monetary policy as well as fiscal stimulus. The sort of the twin forces of enormous levels of debt held by central governments, but on the other side, consumers have built up quite strong balance sheets, paid down a lot of debt. They prevented from big ticket spending on things like holidays now for 2 years. So yes, cost of living is rising. Yes, governments are grappling with large levels of debt. And yes, rates almost certainly will have to go up. But given the size of the debt the governments have got to service, they're not going to be letting the interest rates go up too far. And consumers have got very big balance sheets to withstand some of the cost of living increases. And this is a tightrope for central governments to walk politically. So they're not oblivious to the cost of living issues that the most of their voters are going to be facing. So I suspect the tax rises will be more limited than the economists will be expecting as well. So there is a potential for, as Richard said, for a Goldilocks environment. We probably won't go on a straight line trajectory of a smooth economic expansion, but there's a lot of padding there in the economy as well. There's a lot of demand. West developed economies are very strong in terms of demand, which is obviously why we've got the inflation issue. So there's a lot to absorb there in terms of demand and in balance sheets for companies and for consumers. So we're hopeful, but we're obviously have a nervous eye in terms of valuations and in terms of risk reward.
That's really interesting. Thank you. Yeah, it sounds like there could be some turbulent times ahead, but you've made a good case for the UK, and it certainly seems like there are still a lot of opportunities out there. Thank you for joining us. It's been very insightful.
Thank you.
Thank you. Thank you very much.
Thank you both, and thank you too, Corinne. That's it for this episode of Eye of the Needle. If you want to take a look at our insights page on the website, you can read more around this topic, as well as how other markets and themes are playing out globally. And we'll see you next time. Bye.
Important information. This is an advertisement. This podcast is intended for informational purposes only and should not be considered representative of any particular investment. This should not be considered an offer or solicitation to buy or sell any securities or other financial instruments, or to provide investment advice or services. Investing involves risk, including the risk of loss of principal. Your capital is at risk. Market risk may affect a single issuer, sector of the economy, industry, or the market as a whole. The views expressed are as of the date given, may change as market or other conditions change, and may differ from views expressed by other Columbia Threadneedle Investments associates or affiliates. This information is not intended to provide investment advice and does not take into consideration individual investor circumstances. Investment decisions should always be made based on an investor's specific financial needs, objectives, goals, time horizon, and risk tolerance. Asset classes described may not be suitable for all investors. Past performance does not guarantee future results, and no forecast should be considered a guarantee either. Information and opinions provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. This podcast has not been reviewed by any regulatory authority. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In Australia, issued by Threadneedle Investments Singapore Pte. Limited, TIS, ARBN number 600-027-414. TIS is exempt from the requirement to hold an Australian financial services licence under the Corporations Act and relies on Class Order 03/1102 in marketing and providing financial services to Australian wholesale clients as defined in Section 761G of the Corporations Act 2001. TIS is regulated in Singapore, registration number 2011015559W, by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, which differ from Australian laws. In Singapore, issued by Threadneedle Investments Singapore Pte. Limited, 3 Killiney Road, 07-07, Winsland House, 1, Singapore 239519, which is regulated in Singapore by the Monetary Authority of Singapore under the Securities and Futures Act, Chapter 289, registration number 2011015559W. This advertisement has not been reviewed by the Monetary Authority of Singapore. In Hong Kong, issued by Threadneedle Portfolio Services Hong Kong Limited, Unit 3004, 2 Exchange Square, 8 Connaught Place, Hong Kong, which is licensed by the Securities and Futures Commission, the SFC, to conduct Type 1 regulated activities, CE AQA 779, registered in Hong Kong under the Companies Ordinance, Chapter 622, number 1173058. In the USA, Columbia Management Investment Advisors, LLC, CMIA, is an investment advisor registered with the US Securities and Exchange Commission. In the UK, issued by Threadneedle Asset Management Limited, registered in England and Wales, registered number 573204, Cannon Place, 78 Cannon Street, London, EC4N 6AG, United Kingdom. Authorised and regulated in the UK by the Financial Conduct Authority. In the EEA, issued by Threadneedle Management Luxembourg, SA, registered with the Registre de Commerce et de Société Luxembourg, registered number B110242, 44 Rue de la Vallée, L-2661, Luxembourg, Grand Duchy of Luxembourg. For investors in the Middle East, this podcast is distributed by Columbia Threadneedle Investments, ME Limited, which is regulated by the Dubai Financial Services Authority, the DFSA. The information in this podcast is not intended as financial advice and is only intended for persons with appropriate investment knowledge who meet the regulatory criteria to be classified as a professional client or market counterparty, and no other person should act upon it. Columbia Threadneedle Investments is the global brand name of the Columbia and Threadneedle Group of Companies, columbiathreadneedle.com.